When you first start a business, it's all too easy to mix personal and business expenses. As a result, the business owner receives the false impressions in the earlier days that their company needs to be more profitable and may consider abandoning the idea of running the business altogether. But little do they know that their company is actually doing just fine. Perhaps they just got tricked by their own misunderstanding. Today we will be talking about this problem by discussing the idea of separate business entity concept. What does it really mean? And how does it look like in practice? My name is Nasser. Welcome to episode 1. Pumped to be hanging out with you today. I hope you have an incredible day. Let's discuss today's topic. The core idea of a separate business entity is that a financial statement should only show the results of a business activities, not the activities of the owner. So, when an accountant prepares a financial statements for the business, she must keep the business transactions and the financial affairs of the owner completely separate from each other. That way, the owner and other interested parties such as banks, lenders, potential investors can see how the company is doing without mixing up your own financial affairs with that of the business. Let's take the concept of separate business entity and examine how it might look in accounting. I'm using the example of an investor who got £100,000 in savings and he wants to start a business. The owner, for some reason, is obsessed with chocolates and he's deciding to turn his passion into profitable business by starting a chocolate company by investing his hard-earned money, £80,000. Well done. Now, it is the job of an accountant to ensure that the investor's personal and business finances stay completely and totally separate from each other. Because of this, the 80,000 would be considered part of the capital on the SFP. The bookkeeper, the accountant, would only show an £80,000 balance in the bank account relating to the capital. Some of you who are a bit familiar with the debit and credit, the debit is going to be cash and the credit is going to be capital. Perhaps we should make another small video on that one, but maybe some other time, not now. But you might be wondering, what about that £20,000? Well, that £20,000, that would be considered personal funds and not part of the financial statements of the business entity. So the accountant for the business would probably keeping quiet about that £20,000 in the financial statements of the organization. Now, let's put that £80,000 to work for the business. We will buy tons of chocolates for £10,000, rent a modern shop, and we would also hire some skilled staff for £5,000. I'm talking about monthly expenses, by the way. And let's not forget to lease that dream car and splurge on some other expenses too. Why not? By the end of the month, sales were £20,000. However, when the owner is doing accounting at the end of the month without applying a separate business entity concept, he would discover that he had made a loss of £1,500 considering all of these figures. So I think we should need some help from our trusted, competent accountant to help us out. So let's see if the accountant can turn things around with his magical skills, with his magical accounting skills, especially applying the separate business entity concept. So let's see. Now for this example, let's assume that the accountant noticed two very, very important transactions. Number one, the owner has taken £2,000 worth of chocolates for his personal consumption. Remember, I mentioned that the owner got a particular obsession with chocolates. So how do you treat those 2,000 chocolates? And another expense was that car. That car is not used for business purposes. In fact, on weekends, the car's owner can't help out but show off to unsuspecting strangers, much to the amusement of his closest friends. And while others lounge at home, the owner hits the road in his sleek ride, turning heads and ruffling feathers along the way. Now, the new information will now change everything. Since the chocolates were not sold to customers, the cost should be subtracted from cost of sales, thereby reducing cost of sales and increasing profit it by £2,000. And since the car was not for the business purpose, this expense is going to be reversed, i.e. it is going to increase the profit. In other words, the business made a profit of 3,500 instead. I hope at this point the owner would be rather smiling. I guess it shows that the accountant has an eye for the detail and a nose for the profit. Now, but one might wonder how to treat that £55,000. Well, that £5,000 would be treated as drawings from the business. In other words, drawings will reduce my claim on the business, and the profit of 3,500 would increase the claim on the business. In the end, the closing capital would be £78,500. Perhaps the owner should continue the business and instead should eat only a few chocolates next month and also buy a cheap bicycle instead of driving a fast car if he is interested to make some money out of this business. So what we learned about drawings from the business. When the owner takes money out of the business, it's like taking a little piece of the business with them, like a withdrawal from a bank account, except instead of money, it's claim over the business that is being reduced. So next time you think about taking some money out of the business, just remember you could be taking a bite out of your own claim, which is capital. And we also learned about the separate business entity concept. Next time you see business and personal expenses all jumbled up like a pair of socks in the dryer, do the right thing and sort them out. Just think of it as a fun game of find the receipts, except instead of a price at the end, you will be avoiding a surprising or perhaps rather nasty surprise from the tax authorities for the audit. So it's almost a win-win game. I hope you like the topic. You take care and thanks for watching.